Morning, everybody. How are we all doing? How is everybody? Is everybody here? Is anybody here? Always the more prevalent question to ask. Is anybody here? Morning, Forex Fire. Morning, Bill. Morning, Danny. That's 3. I still can't find a way to figure out how many members are in here in these streams. It's really stupid, YouTube. You really just need to have a counter like you do for normal streams as to how many people are there. Really easy. Is anybody out there? Pink Floyd, yeah. Did you find the music? No, I didn't. No, I didn't. I completely forgot. No, I totally forgot. I don't know where that is. I thought I had an imports folder which had the music in it, but I can't find it. It's vanished. No. Well, I wonder if it's in there. Assets. That might be it. Hang on. Hang on. No. It's not that. That's a video file. Hang on. Hang on. I think I might have found the right folder. This is it, isn't it? That's it. It's called Shut up. It's called Vital Whales by Unicorn Heads. Vital Whales. Unicorn Heads. There you go. Share it in Discord. I can do that. No, I can't. It's far too big. It's 17 meg. I can only share 10. I can't. No, I can't. It won't let me. What if I zip it up? Hang on, let me zip it up. See if I can zip it. One sec. This is an interesting stream for everybody that's not interested in that tune. That's now 15 meg. That doesn't help. No, I can't. Go and Google it. Unicorn Vital Whales by Unicorn Heads. I'm sure it's out there. Right. Morning, everybody else. Morning, Forex Fire, FTNet, Danny. How are we all doing? Right. So today we are covering market condition and signal indicators, which ones to choose. So this is a little bit of it's obviously a follow-on from yesterday, looking at the 3 main types of indicator. So we've got condition indicators, signal indicators, and level indicators. There are only 3 indicators, if you like, in total. And there are a billion different variations of them. But as long as you understand and can compartmentalize every indicator you find into what it is, what type, it will stop you over indicatoring your charts, basically, which is something that people go through a lot. And I think the reason I know this is because of the amount of time I have spent backtesting. I've been backtesting strategies for 17 years. And I know that if I am going to do a position trading strategy where I scale in to multiple trades and I use an RSI, a stochastic, or a CCI, I get the same result. Therefore, this thing doesn't matter. It doesn't matter which of them I use. It doesn't matter if I use a 21 or a 14. It doesn't matter which CCI numbers I use. It doesn't matter if I get in at the 70 level or the 80 level. This is why I make money not that. So pick one, pick a number, put it on your chart, use it. It's telling you that there is a condition in the market that has happened. Whether it's the right time to get in or not has nothing to do with the indicator. It's just telling you something's happened. Yeah. So the condition indicators, which is what we're going to focus on today, and signal indicators are all telling you the same thing in a slightly different way with a slightly different sense of input, or volatility, if you like, or sensitivity. That's the word I'm looking for. So what we're going to look at today is the three main strategy types. So every strategy as well falls into three categories. There's a lot of threes, yeah, in trading. So there's three strategies. There's only three: mean reversion, trend, and breakout. There's only three indicator types, which we know are the condition indicators, the signal indicators, and the level indicators. There's only three things that price action can tell you: it's bullish, it's bearish, or it's indecision. Yeah. There's only three outcomes to a trade. When you take it, it either hits take profit, it hits stop loss, or it doesn't go anywhere. Pretty much the same as what price action does, doesn't it? Yeah. Everything works in threes. There's only three levels of pullback on a Fibonacci. It's bizarre, isn't it? But that's the way it is. So what we're going to look at first of all is the three main strategy types. So mean reversion, trend, and breakout. Okay, so with each of the strategies that you will trade, whichever strategy it is, whether it uses a stop loss, whether it's a position trading strategy, whether you've got a timed exit on it, whether you're trading 5-minute charts, whether you're trading daily charts, whatever it is, whatever you're trading, it falls into one of these three strategies. So you need a different condition indicator for each type of strategy. Yeah. So taking the first one with mean reversion. Yeah. With mean reversion strategies, you are looking to take the inverse of what has happened. Yeah, so that is the definition of mean reversion. A Bollinger Band is the best way to explain mean reversion, which I will put on now. Just use a 22. Yeah, so basically when you have a move, we are looking for that move to revert back to the mean. So this is the deviation, and this is the mean, the moving average, basically. So a mean reversion strategy is where price has moved and you are taking the counter move. So you are waiting for the exhaustion move, the pullback, continuation, or the reversal, whichever it is. One of those three things is going to happen. Morning, Linus. Watching at 2x to catch up. So basically, with mean reversion, when you get into your trade, you either want that to happen or that to happen. Yeah. Don't know which, don't know how far, but you either are going to be taking a mean reversion on a continuation or a reversal. Yeah. So that's mean reversion trading. So with mean reversion, the condition indicator that you use has to have defined price has moved. Yeah. So we're looking for price to have done something, to have moved a distance, because mean reversion is playing on exhaustion. Yeah. So Bollinger Bands are a great example, or any oscillator. So if you stick any oscillator on your chart, pretty much, not everyone, but I'll put the RSI on and I'll put good old stochastics on. Let me just put both of those lines on so they can be seen. So for a mean reversion strategy, you need, obviously for all strategies, you need a condition, you need a signal, and then you need a target and a stop. Yeah, or an exit strategy, which is more defined. Yeah, so the exit strategy or plan, could call it that as well. Yeah, target is always very simple. Yeah, where do I think price is going? If it gets there, I'll get out. If it doesn't get there, you can either get out with a stop loss, not the best idea usually, or you can have an exit strategy where you will exit after a period of time and take whatever you get, or you'll have a plan to scale in position trading. Yeah. So you need a condition indicator that has indicated price movement. That can come as two types: oscillators or bands, typically, or you could use level indicators like pivots or ADR or AWR. Yeah, so average weekly range has been exceeded, probably going to mean revert. Average daily range has been exceeded, mean revert. A pivot point, which is a calculation of the open, close, and range. High, low, and close is what pivot points are calculated off of. If it's reached that, chance of mean reversion. So you could use levels, yeah, but levels on their own aren't good for mean reversion, because it's the way that price gets to the level that is important, yeah. So if something does this throughout the day and hits ADR, it's less likely to go like that, isn't it? If something powers to ADR within 3 hours, it's more likely to be exhausted, yeah. So just hitting a level, so let's say there was a resistance point there, just grinding up to that resistance isn't as impactful as hitting that resistance hard, yeah. This is what condition indicators are going to tell you. So when a stochastic has moved from a very low point to a very high point, it means that market has moved. When RSI has moved from a low point to a high point, market has moved. When the price is outside of the Bollinger Band, it's moved. But it's not just moved, it's moved fast, yeah? So with any mean reversion strategies, it's not the fact that it's extended beyond the level, it's the fact that it's got there fast, yeah? So there's a good example where we have got above that level, but look, it didn't actually go below the 50, and it just sort of ground around and then tapped it. Didn't really get much of a pullback on that there. This one, where we shot up to it really fast, we pulled back probably 38% of that move, yeah? The reason it pulled back is because of the speed it got there, yeah? So remember the climbing up the stairs, falling down the elevator shaft scenario that I always talk about. That's the reason it falls down the elevator shaft, is because of the speed it hit the top at. If something grinds up there, it doesn't tend to come down fast. It tends to come down slow, yeah, because it's grindy price action. So oscillators, basically, if you're using a condition indicator for a stop loss based strategy, the best use that I have found is not using them when they get extended. Either it's using multiple time frames of them. So I've got a multi-time frame stochastic indicator, for example, which is free, basically. Don't even know where it is. Oh, I've got it on a template. So this is a multi-time frame stochastic indicator. So it will indicate multiple time frames, basically. Actually, this isn't. This is a different variation of it. But this is a 5 minute and this is a 1 minute. If I go around to the right time frame. Yeah, so when the 5 minute is doing the same thing as the 1 minute, the probability is higher, typically. That's basically the way it works with those types of indicators. The best way, however, I found to use them is if they get from the low point to the high point within a period of time. Yeah. So for example, the RSI, you're going to find this a lot more difficult to achieve on, because the RSI is a much slower moving, because it measures the relative strength rather than just the price movement. Stochastics is a good example. So if your stochastics gets all the way from the low point, which you can't see because it's off my chart, move that over. Yeah, so if it gets from the low point below a level to the upside of a level within the trading day, for example, or the trading week, whichever time frame you're looking at, but a period of a session, like the probabilities of it exhausting are much higher than if it basically grinds from the middle all the way up to the top. Yeah, so you're going to find instances like this occur a lot less, but that's basically the best way to use them. So with mean reversion strategies, oscillators are very, very, very good. Yeah. So they are telling us that a condition has been met in the market. They are signaling to say we've moved above an area. So for mean reversion, we need price to have moved. Otherwise, we can't mean revert. It's absolutely useless to us, an oscillator, for a mean reversion strategy if it's doing that. Yeah, no use whatsoever. There is a use for oscillators when it's doing that, which we'll look at in a minute. But that's basically how you could use oscillators for mean reversion. Bollinger Bands are an incredibly popular condition indicator for mean reversion strategies on low time frames. However, when I've tested them, I found them incredibly unreliable. The way that everybody tends to use Bollinger Bands is when we get outside there, we target the moving average. The problem is if it stays outside there, the moving average actually moves up almost to where your entry is. By the time you get back to there, you haven't got a profit. So on paper, it looks great. In practice, doesn't tend to work very well. There's a million different Bollinger Band strategies out there. And, you know, you'll see on instances where it's like, wow, look how easy that was as a trade. You get in when it's outside and you come back and you target the highs. When you actually backtest it over a long period of time, there are an awful lot of instances where it's outside and it just does not get back to the mean, or it gets back to the mean and you exit and you're actually in a loss. So this one is a good example. We enter there and we exit there. It's a loss. It's a massive loss. But that's the mean reversion. Not right, is it? So there's lots of different strategies you'll find that just do not work, basically. But you go back through the charts and you can find loads of examples where they do. But you only, and this is what everyone does, isn't it? It's like, hey, look, that worked perfectly. Hey, look, that worked perfectly. You forgot about this one that made that much loss and completely cancelled out all of that. Yeah, you only look for the good when you're backtesting visually, which is why automation is good, because it doesn't look at the good, it looks at everything. So so those are the best strategies, the best indicators to use for mean reversion strategies. An oscillator. Now you can fine tune the oscillator. So RSI is a good example. As we know, there are a lot of different RSI levels you can choose. So you can go with a slower RSI, which will give you a slower signal. You can use a faster RSI, which will give you a faster signal. But the way that I have found to fine tune indicators is basically to start with the basic setting they come with as a default, which is 14 for the RSI, for example, and is, I think it's 9.3 on a stochastic. Or is it 14.3? Can't remember which one it is. 5.3. So 5.3 on a stochastic. So basically using the default and then just seeing if there is an edge there. What you tend to find is as you go down to lower time frames, you need to slow down the indicator because it gives too many signals on low time frames. So by actually fine-tuning the indicator down, which in this case would mean increasing it, the sensitivity of it, you tend to get better signals. So it's a bit of a hit and miss thing, but there is never a right or wrong. So in this particular case, using the 21 RSI was absolutely spot on. But you could have also used a Bollinger Band entry. Yeah, you could have used a stochastic. Yeah, do you see what I mean? They all do the same thing because all they do is track price movement. But for mean reversion, the entry criteria is price has moved. So you can use any one of them. Yeah. Breakout strategies, oscillators and Bollinger Bands, again, probably the best for breakout strategies. When you're trading a breakout strategy, what you are looking for is contraction. Yeah. So we are looking for price not to have moved. Think probably the most popular or the most well-known breakout strategy there is out there. London breakout strategy. Yeah. We get the Asian range. We take the Asian range and we wait for London to move outside of it. We take that trade. There's 1,000 variations. You don't take the first one, you take the retest. Actually, what you do is you mean revert the London breakout, or there's 100 other people telling you to do the same thing, which is basically some kind of random buy or sell based on something having done something in the past. Yeah, all strategies are the same. They're just a 50-50 shot as to trying to put probabilities in your favor. But a breakout strategy needs to identify a period of contraction in price. So oscillators and band indicators, and I'm going to keep talking about the Bollinger Band because there's very few band indicators out there that aren't based on Bollinger Band theory. Basically, for those that don't know, probably do, but if you don't, you need to know. Bollinger Band is basically a standard deviation indicator. So what we are doing is we're taking a moving average, in which case here we're looking at the 20 period moving average. So if I stick a moving average on here, same thing. It's literally is just a 20 standard moving average. Yeah. And we are measuring deviations from the moving average. That's what a Bollinger Band is, which is why you'll see the inputs there. That's now going to select the moving average. Yeah. So we are looking for 2 standard deviations. We could go, show me 4 standard deviations from the moving average. Yeah. So that's all a Bollinger Band is doing. And you can obviously adjust it, as I've just done there, to make it more or less sensitive. The bigger the setting, the further price has to have gone. But what we're looking for in any breakout strategy is an accumulation or a contraction where price doesn't do much, because usually when price is accumulating, it is because the market has found balance. So banks and institutions have found an area they can execute large volumes of order at a single price point or a range of price points, which basically gets the orders off their desk, and it makes everybody happy because they're just sitting there happily getting the job done. At some point, some bank or institution is going to come along with a whacking great 500 million order and go, I need this executed. I'll take everything you've got short up to that point, and then is any more shorts coming? No? All right, who's got the next one? And that's what a breakout is. It's basically an institutional order that comes along, and typically from a breakout you get a propulsion move, which gives us a propulsion gap. Yeah, here, propulsion gap. What did that propulsion gap come after? An accumulation. Yeah. So when we see propulsion gaps, the best ones are the ones that are breaks of ranges. So to get that identified, you will usually find your oscillator is sitting within the middle, because there is no strong move up, there's no strong move down, or there's a continuation of strong moves up and down, which cancels the indicator out. Don't forget, all oscillators do is follow price in the past. Yeah. So with all oscillators, if we are sitting, I'll stick a couple of extra bands on here to demonstrate the point. Let's put 60-40 on. Yeah, so there's your 60-40 line there and there. So if you see price for a period of X bars not getting outside of that, you know you have found an area of balance, an area of accumulation. Yeah. So for breakout strategies, you want to use oscillators and you want to set conditions where they're not moving. Yeah. So what we're now doing is we're waiting for the explosive move to come. The problem with using oscillators is they will still give you a similar reading when price is just grinding out of a range. Yeah. Which is not a breakout. It's just basically a grindy move. Now, it is technically a breakout, but the problem with range-bound activity is it's choppy. We have big, long wicks, and we don't have a defined high and low. We will always have a defined high and low. At that point, it was there, then it moved to there, then it moved to there. So that became the high. When we started the range, it was there, then it moved down to there, it pushed back up again, then it made a slightly lower one, then it pushed back up again, and then it sort of broke out, but it pushed back up. So you started off with your range low there, then you moved it down to there, and you moved it up to there from there. So the range actually started here, then it expanded to that, and then we sort of broke out, but there's no way you're taking that as a range because that gives you a negative R. No use, is it? What we need is an explosive move. So the best way to look for breakouts is when we've got news coming. So using a band or an oscillator where we can identify we're not really going anywhere because price is stuck within the middle. And you can see stochastics is so much more sensitive, which is why I use RSI most of the time, because stochastics, with the very smallest price movement, it's great for scalping, for quick in and out type trading, but it's so sensitive. It will give you, like, from that point there to that point there, yeah, which, yes, it's an upward movement, but look at the size of the channel. It's tiny, isn't it? It's almost part of this big range. It will give you an oversold and an overbought reading, which again is a stock term. It's nothing to do with forex, but it's a little bit too sensitive. So slower oscillators like RSI, CCI, MACDs, those sorts of things, moving average convergence, divergence. So if you've got the MACD lines doing that, it means the moving averages are not converging. If they are not diverting. If they're not diverting, it means you've got a range. Yeah, think about putting moving averages on your chart. If the moving average is going sideways, it's not going anywhere, is it? Yeah. And again, we'll look at moving averages in a minute. But so looking at bands just before news events come up, those are your breakouts. Or just before market opens, yeah, is also a good time. And again, we're just looking for contraction in price. We're looking for a range that has formed that we can take a breakout of. The reason breakout trades or strategies fail or have a very high failure rate, usually in the 60 to 70% failure rate, is because when you find a contraction in price, it will often overshoot the highs and lows as we have small price discoveries by the bank, which means you're in, stopped out, in, stopped out, in, stopped out over and over and over again. So identifying it and then waiting for the propulsion move and retest is usually the best thing to do with breakout strategies. Propulsion gaps, again, they tell you everything. They tell you when the banks are entering the market. But breakout strategies, you have to define a range to break out from. And using indicators rather than drawing levels is the best way to do it. So what a lot of people do with breakouts is they will come on and they'll manually draw in a level. I'm just going to, let's just find, some better price action. Oh my God. Yeah, so, I mean, if we look at this sort of little range here. So the trouble with breakout strategies is you will define a range. So I see that price action, and what I'll do is I'll go, we've got a range forming there, yeah, and now it's broken out. So I haven't, as you can see here, got price action sitting around in there, and this is how the indicator helps you. If you draw a range but you find that price is not sitting inside the middle of an oscillator, whichever one you've chosen, and again, it's personal preference, you probably haven't found a range. You're in a trend, a very weak sort of slidey sort of trend. But as you can see, price returns back inside there, and that's the point I would say, right, let's see if we can sit there for X number of bars, 5, 10, whatever, and then we'll start drawing our range. So we entered back in to the range there, so that's the low, and then we'll look to find a high, which would be defined up there, and price sits around in our oscillator, and obviously it pushes down a little bit there, but you see we haven't broken the range here, look. Yeah, so we've defined the range when we get into an area of going nowhere, but there's no propulsion move. Testing the high, not broken out. So that would be where you would take your breakout, and obviously, as you can see, the breakout failed, but we didn't get a big strong move on the oscillator, did we? Yeah, so they are really good for defining ranges, but on the whole, I have really struggled forever to find a good breakout strategy, because on forex or on anything, because price just moves up and down all the time. It's fluid, so you are always going to be going higher than a previous level because the supply at that level will run out. But it doesn't mean the price needs to go up to there. It means it needs to fill its orders, and once it's filled its orders, it will come back down into the area of balance, because that's where it needs to be. What you do find happening is at market opens on indices, you get a massive move. On news, you get a massive move. So range breakout trading for me is about defining an area before an event. You have to know the event is coming. Just making strategies try to work generally without a catalyst is virtually impossible. But using oscillators before to identify a range bound condition before news is useful. Yeah. So think stock index hedge opening range breakout strategy. We're using the bars before the breakout. Yeah. So with the SIH strategy, I'm looking for a range between 10 to 20% of the average daily range. Yeah. In the first half an hour before the market opens, to say, right, there is an area that price has been contracting in. Yeah. I know that at 8 a.m. guaranteed this thing's going to go. Whether it goes up, down like it did today and then sits around going nowhere or not has got nothing to do with that range. The strategy is a momentum breakout strategy. All breakout strategies are momentum breakout strategies. To have a breakout, you have to have a contraction. These measure contraction. Yeah. So Bollinger Bands are also incredibly good for this. So the standard is 22. Yeah. So when you are not closing outside of that band and you're sitting around the moving average, what happens is the bands contract. When we're in an expansion or a breakout, the bands get further apart. Yeah. So you can tell there's a contraction, and as we've got bigger there's more volume coming in. Yeah. Didn't manage to get a breakout there. Contraction here, breakout, expansion. Yeah. So for mean reversion trading, this is why the people use the Bollinger Bands so much when they're using stop loss based strategy, because it tells you both. It tells you when a breakout is likely to occur, and it tells you when a mean reversion is likely to occur. It does both. It's such a versatile indicator. But it's also got a very strong failure rate, because when price is breaking out, it will continue to break out until it finds an area of resistance. So when you've got a Bollinger Band breakout and you're coming up to a resistance or support area, pretty good. But you can tell that by price action with a 3-bar reversal at that resistance level without the Bollinger Band. So you don't need it. Again, personal preference. Personally, I would rather just watch price action. Other people would rather have the confirmation of the band. Again, it's entirely up to you. But you need to understand what the indicator is telling you. Yeah. So Bollinger's a great condition indicator. So is RSI. Most oscillators are. But you need to understand that they are telling you that there has been an expansion in price and there is a mean reversion opportunity, or that there's a contraction in price and there is a breakout. Yeah. So those are the best indicators that I have found historically for pretty much any mean reversion or breakout style trading strategy. Contraction, this is the closest thing, the Bollinger Band, to being able to read volume, because when you get tight bands like this, it means there's no volume in the market. Yeah, it's not moving anywhere. Another thing you can use as well, which you've kind of got on the chart already, but is a moving average. So again, this brings us on to the third one, which is trend. So you stick a moving average on your chart. Yeah, if the moving, and the thing that everybody uses moving averages for, which is in my opinion wrong, is if price is above the moving average, the trend is up. Yeah. What you should be using is the angle of the moving average. If the moving average is on each candle close, let's zoom in. Yeah. So if the moving average here is there and here is there, the trend is up. Yeah. Because the average price is increasing. Whether the price is above it or below it is down to volatility of movement, not direction. Yeah. So in a bull move like we've got going on here, it will move down below the moving average, but look at the angle of the moving average. Yeah. The angle of the moving average is still pointing up. We're below it. So if you were to get into a trend-based trade right now, you would be looking for a pullback to enter long. Yeah. most systems and strategies, they tell you if price is below the moving average, you look for shorts, but the average is pointing up. Yeah, direction. Yeah, so for trend-based trading strategies, any moving average will do. Let me just remove these off the chart so that they're not clogging it up. So with a trend, these things are pretty useless. We've got to find a trend. There we go. This thing's pretty useless. Yeah, in trends. Yeah, mean reversion indicator, a condition indicator that signals price has moved is no good. I know it's moved. I can see that. Now, how do I get into the trend? A lot of people will use an oscillator to try and get in on a pullback. It will give you many, many, many options to get into pullbacks. Yeah. So the stochastic here had 5 signals during that pullback to go long. 1, 2, 3, 4. There was another one in there somewhere here. 5. So you stopped out, stopped out, stopped out, stopped out. You got it. Well done. So now you've got to get a 5R just to pay for the 4 stop outs. No use whatsoever. Yeah. So if you're trend trading, you need to basically use 2 indicators as your condition indicators, in my opinion. First is a moving average. Yeah. So if the angle of the moving average is pointing up, it's long and you want to go long. Yeah. Now, the angle is something that's very difficult to measure because the angle of a moving average is broker dependent. So depending on your broker's data, you're going to have a very different reading on your moving averages to most other people. But the angle of the moving average will either be up or down, or it will be virtually sideways. Yeah. So when you go into periods of accumulation, you will find that something like the 20 period moving average is constantly saying you should go long here. Yeah. After price has moved. Yeah. If we stick another moving average on there, like a 50, let's pick a decent color that actually is visible. Horrible blue. But if you use something like a 50 period moving average, you can see that the angle changed from pointing down to sideways to up here. So that is where the moving average started pointing up. So even though the price there was below the moving average on the 20, it was above the moving average on the 50, but the angle was still pointing up. It didn't start pointing down until here, telling you that now you should be looking for short opportunities and you should keep in your shorts until it starts to push up. Yeah, so on average now for the last 50 candles, it's pointing up. So for trend-based strategies, to allow you to hold your trades longer and get in at a period where you know that price is on your side, you should measure the angle, or rather use the angle as either a positive or a negative signal, not whether it's above or below the moving average. If you use above and below the moving average, you are going to get chopped to death over and over again. In fact, you get chopped to death in trends all the time anyway. There's nothing really that can stop that, which is why the strike rate is so low on trend trading. But at this point here, for example, on the 20, the angle started to point up. You'd have caught all of that. On the 50, you'd have caught it somewhere around about here. Yeah. Huge difference in going long there to going long there, isn't there? Yeah. So, but it's not because price was above. It's because the angle was pointing up. The other indicator to use for trend trading is Fibonacci. Yeah. So when you see a breakout occurring, you basically measure that move and you continue to measure that move until that move is over and it's pulling back. And then you wait for a pullback in the trend to a level. Yeah. So it's a level indicator, obviously. But you need to also have confirmation that the condition is still long. So you need a longer term moving average for trend trading. So most people will tend to use something like the 100 or the 200 moving average, and it will be the angle of that moving average. That's a really bad example for a trend because it's a parabolic move that didn't actually go into a trend. Let's find a trend. Here we go. That's a better one. Yeah. So we've identified a trend here has started, which was what? Accumulation breakout, propulsion gap, retest of the propulsion gap if you had the propulsion gap indicator on there. But the Fibonacci basically gives you levels to time your pullback. So as long as this thing here is pointing up, we are going to continuously look for long opportunities. So the condition indicator for trend is that, and the condition indicator is also this. We haven't looked at signal indicators at all yet. Remember, this is all about condition indicators at the moment. So trend trading, you ideally want two conditions. You want the trend direction by the slope, and you want something to tell you when the pullback is underway, because the only way you're really ever going to benefit from trend trading is by trying to time the pullback. And again, this is why it's so difficult to do. The one thing, if you've watched the bootcamp, you know that we cannot do as traders is time the market. It's impossible, because it's not down to us, it's down to order flow within central banks, within banks and institutions, as to when the move starts and which direction it goes. We can't control any of it. But if there is always going to be a bias of long orders over short orders, we are going to go into a trend, and it's going to continue. So what we're looking for is the profit take moves, the mean reversions, to be completed, and they tend to be in pullback levels, and it's always typically 38 to 61.8 retracements. Those are the shallow 71.9 as well as a deep pullback, but somewhere in there is where you want to be looking. So as long as that is still pointing up and we get into this kind of Goldilocks zone, this is your condition to start looking for buy signals. This is the condition that has to be in place with this condition, and that's pretty much it for trend trading. So condition indicators are we going in a direction? Are we pulling back against that direction? Those are the two conditions that are met, and then you wait for a signal. That's it. Yeah, I have never found another way of identifying trend condition other than moving averages. There's lots of others out there, and again, Bollinger Bands is another reason people use Bollinger Bands, is they use the slope of the Bollinger Mean, which is the moving average, and then they use the outside the Bollinger Band to go long in the slope of the mean, which is great. But you, in my experience, you need a longer term moving average, because you're trying to jump on the longer movement. Bollinger Bands, unfortunately, only show you one moving average. Yeah, so they don't work as well. So a combination of fib and this has always been the best way to trend trade. The problem with trend trading is you have to get the timing right. So the condition is always going to be somewhere around, but you could say that with any mean reversion or breakout strategy. It's got to be somewhere around there, or it's got to be somewhere over this level for the mean reversion to happen. Yeah, so you take the mean reversion up there and you take the long there. Yeah, that's how it would typically work. But the problem with trend trading strategies in the whole, which is again why I don't do them, is to make them profitable, you have to get in and have a tight stop. There's an awful lot of things that have to fall in line for a trend trade to work. With a mean reversion trade to work, it's very simple. Has it moved? Yes, it's probably likely to pull back. With a trend trade, you've got the, is it going to continue trending? Which level is it going to pull back to? And have we got any news events that are going to screw me up? There's so many moving parts when you're trying to jump onto a trend. And the other problem with trend trading is, to actually make money out of it, you've got to have a high risk reward ratio, because you're going to get stopped out 60 to 70% of the time, which means if you get stopped out 5 times in a row, you're 5% down on your account, just assuming 1%. So every time you get a trade right, you have to have at least a 5R to make money, which means that when you identify a trend and the trend continues, which has got a 50-50 shot of happening, and you manage to get the entry right, you've then got to wait for it to move 5R in your favor, which may not happen because something will push it back the other way, to actually break even on your account. It's incredibly difficult to make any trend trading system profitable. The reason trend trading systems are profitable is because when they catch the winner, you have to hold it. And that is designated by when the moving average changes direction. So the trend here, moving average slope went up, enter. You do not get out of that until that thing points down, which is somewhere around about there. But the problem with it is, in here you are in short, in long, in short, in long. You are chopped around 10 times, getting 10% loss on your account to make back possibly 15% if you're lucky on the big run, if the big run happens. If something like the euro pound hits you and the thing sits around and goes sideways for that amount of time, yeah, 2 weeks, and then moves down and then sits around for 2 weeks, yeah, you can be 6 weeks in a trade before you even get paid. So it's very, 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 very difficult to make them work. But those are the condition indicators for trend trading. Literally, it's a moving average. That is your main condition, because you have to have something moving in a direction and it has to have broken out. So you kind of need a breakout, like an RSI extension to the downside, as a condition, with the angle as a condition. And then you need to make sure you get in on something that's going to give you the risk reward ratio that you need to make money with trend trading, which is the pullback. So you've got to have two conditions in trend trading. Every other strategy just needs one condition. Yeah. If you try to stack conditions in any strategy as well, you are just adding extra complication into the strategy. So if you wait for the stochastics to be extended, the RSI to be extended, and everything else to be extended, all the other oscillators, and you draw a line when they all hit there, yeah, first of all, the condition has got to have three things before you get in. So the chances of all three of those lining up at the same time increases the probability dramatically, but reduces the number of trades you'll ever get into, potentially. And also, when you hit the button, there's still a 50% chance that that will or won't work. So just pick one. Yeah, don't have to overcomplicate it. Any strategy you see with multiple condition indicators is just double checking itself, but the probabilities don't change. It's still 50-50. Yeah, so those are the three main strategies and the three main indicator types that you associate with them. Don't forget, we've only got three indicator types. Which one you choose is entirely up to you. So all I would say is, when you're looking at condition indicators, look at the time frame that you're trading on. You can't see because it's off the screen. But if you're trading low time frames, you need fast condition indicators, because low time frames you tend to want to scalp on. Yeah, but you can scalp on any time frame. But the more sensitive your condition indicator is, the more signals it's going to give you, the more chances there are of you entering trades, the more money you can potentially make. However, the more stop outs you can take and the more losses you can make. It's all relative. So it's all about fine tuning. But that's basically it for those signal indicators I wanted to cover. It's very, very quick, which you're probably going to understand when I start talking about what they are. So every strategy needs a signal and a condition. The condition, once the condition is met, is basically your standard, your standby. So think about traffic lights. You've got a red traffic light. Can I do colors? I bet I can't pick the right colors here. Really? Is that all you're going to give me? They're wrong. Anyway, doesn't matter. I'm just going to use black because it's easier. So you've got traffic lights. So the condition indicator, at the moment you're standing on red. Yeah. If you're in the UK, this will make sense. If you're in other countries where your traffic lights are different colors, sorry. But that is you basically sitting here waiting for a condition indicator. The condition indicator is when you move to amber. Yeah. So RSI is extended, stochastics is extended on our mean reversion strategy. We've now got a condition in the market that we're ready to get in on. This is the final part of the puzzle, the signal. Yeah. So the condition is right, but what I need is the buyers or the sellers to be in control of the market so that I can get in on their move. So all signal indicators are a pull the trigger button. or the condition. So the condition has been met, and now I need to pull the trigger. You're probably not going to be surprised. There are only a couple that I will ever look at. First of all is price action. Yeah, so if price is pushed up, it's stuck, and it's coming back the other way, there's my signal to go short. If we've had a whacking great bull candle and a bigger bear candle, there's my signal to go short. If we've pushed up really hard and the sellers have taken control, there's my signal to go short. Or if there's been a push up, a pullback, a push up, a pullback, and we've got a reversal alert where the structure's broken to be bearish, there's my signal to go short. It doesn't matter. Yeah. So signal indicators are the least important thing that you have. And this is what everybody spends their entire life looking for. The holy grail of signal indicators. The one that gets you in with the highest possible strike rate. It doesn't matter. Flip a coin. Use a moving average, whatever you want. A moving average is another great signal indicator. If price has been pushing up and now it's not, it will cross below the moving average on the 9 or the 5. Use the 9 or the 5 moving average. Yeah, you don't even need to read price action. Did it open above there and close below there? Yeah, then the bears are in control. Did it open below there and close above there? Yeah, the bulls are in control. If I want to go long, I want them. If I want to go short, I want them. Simple. Moving average, 5 and 9. Simplest things out there. Every stock trader on the planet will have either a 9 or a 5 on their chart because it's the only signal they use. Yeah. Have we got less sellers in the market now than we have buyers? Yeah. Do I want to buy? Yeah. That's the condition I need. I need the signal to be there aren't as many of them, there's more of them. Why? Because I'm going that way. And if I'm going to get on that, I need a load of other people to be doing the same thing. So signal indicators are very, very, very simple. Doesn't matter which time frame you're on. It's basically these guys. If I want to go short, it's them. RSI's extended. Sellers are coming on. Brilliant. Let's get on board. But by the time you get on board, your condition indicator will probably have lapsed. Yeah. So condition has been reached. Looks like we're turning the other way. Probability is 50-50. The next candle that happens is either doing that or it's going to confirm what your condition indicator has told you. That's it. So it's up to you what you use, but stop hunting for signal indicators. 90% of the systems and strategies out there draw an arrow on the chart. Go and look at every one of those that you've ever found. I'm just trying to think if I've got any. Brain trend signal alerts. Stick that on. Don't know what it is. Oh, look, draws arrows. Perfect. Right. I don't even know what this is. It's called brain trend to signal alerts. No idea. But there's a little arrow there. Yeah. Why? Because there's been a bear candle. There's a little arrow there because there's been a bull candle. There's an arrow there because there's been a bull candle. There's an arrow there because there's a bear. There's an arrow there because there's a bear. There's an arrow there because there's a bear. There's an arrow there because there's a bull. Doesn't matter. So you can use this if you want. Does exactly the same as price action. Does exactly the same as a moving average cross. Yeah. So this arrow appeared as the bears entered. It opened above, closed below. And if you wanted to wait for a reversal alert, it's actually going to be gap down day, so you can't really tell. But you get the point. It doesn't matter. The signal indicator is basically anything that's telling you that there's something shifting. Yeah. With all trading strategies, every single one of them, they are a reversal strategy. Yeah. So some people will say, what type of trader are you? And you say, I'm a trend trader. And other people will say, I'm a reversal trader. It doesn't matter. You're both the same. What you're looking for is price action to confirm what you think. So if you're a trend trader, you're looking for an up arrow when the moving average is moving up. If you're a mean reversion trader, you're looking for a down arrow when it's going down. Yeah. Also, if you're a mean reversion trader, you're looking for an up arrow when it's going down, and the same as a trend trader would be. Yeah. Doesn't matter. All it is it's telling you one thing, that price is going in the direction that you want it to. Yeah. So signal indicators, just stop looking. The easiest thing to simplify your life is to stick a 9 or a 5 MA on your chart. And it doesn't matter which, because sometimes one will be better, sometimes another will be better. If you're a mean reversion trader, you might want to use an EMA rather than an SMA, because EMAs move more with volume and volatility. So propulsion candles, the EMA, it's a good example there. That's a propulsion candle. Let's change that to a 5 SMA. Yeah, so the SMA is more of a steep line. Yeah, the EMA will signal a little bit later in volatility, as you can see. So the SMA triggered there, the EMA triggered here. So EMAs are more conformational in high volatility. So that's why I mean, it doesn't really make a lot of difference. It's a candle, one candle. But it's slightly better, and people recommend EMAs over SMAs because they're more dynamic. Yeah. But pick one of those, a 5 or a 9, and it will completely revolutionize your hunt for the Holy Grail, because you don't have it anymore. It doesn't exist. So that is it. We've had it on our charts all our lives, and we've never noticed it. It's the best signal indicator in the world because it tells you that the people are going in the direction you want them to go. That's it. That's all you need to know. But this is the most important thing for your strategy type. The condition indicator is the one that sets up your entry. The signal is irrelevant. If you want to wait for 3-bar patterns instead of just using a moving average, do it. You're going to get way less of those than you will those, though. If you enter a strategy and you get too many signals, change it to that. You'll get a lot less signals. Your probabilities are still 50%, but we're going to reduce our losses because we're not taking so many trades. Yeah. So simplify signals. Market reversal alert. The reason I created that was because I wanted more confirmed signals. Yeah. So the bulls tried to take control. They failed. Then they did. Yeah. But look at the signal with the moving average here, for example. This is the 5. Yeah. This is the 5 EMA. Yeah. That is the signal to go long. That is also the reversal alert. That is also a bull candle, which would have drawn a little arrow. That's a bullish engulfing. It's part of a 3-bar reversal. It's the same thing. Yeah. Whether you get in there or there has got nothing to do with making money. What happens after you get in is how you make the money in the market, not the reason you get in. So forget signal indicators. Just pick one, whichever one you want to. Reversal alerts are going to get you in sometimes slower than a moving average. That's the reversal alert entry. That's the moving average entry. Which is the best of the two? If the market goes down, that one. If the market goes up, that one. Because this one wouldn't have signaled short. Yeah. Which is it going to do after that has happened? Random. So it doesn't matter. You don't have to focus on it. But you do need a reason to get in. So if you're a mean reversion trader, price has to have moved. If you're a breakout price trader, price doesn't move. If you're a trend trader, it needs to be continuously moving. Yeah. So this measures movement over distance. This measures no movement. This measures movement at speed. Yeah. 3 different conditions for 3 different strategies. But the actual name of the oscillator you choose, or the number of the moving average you choose, is totally discretionary and based on the price action you've seen in the past, which won't be repeated in the future. Yeah, you just got to pick one and use it. That's it. There you go. That covers it. So that is basically how to match the condition indicators to the strategies. So it's as simple as, what type of strategy am I looking at? And have I got the right number of indicators? Or I want to build a strategy. How do I identify the condition? And literally, it's just a case of using price action. The other thing that I was going to cover as well, which I think I'm going to put into tomorrow. Yeah, I am. Because it's a little bit of a hybrid, but the other condition indicator that we have is distance. Yeah, so for example, ADR. Now, ADR is what we're going to cover tomorrow is target and level indicators, and the main ones to use. ADR obviously is one of the main ones to use because it measures dynamically the average movement of the instrument. It is also a condition indicator, isn't it, for mean reversion? But it is a level indicator. So I wanted to cover that one tomorrow, but it's kind of a hybrid because it fits in as a target indicator. It fits in as a condition indicator, and it is also a level indicator. So it's kind of dynamic in the fact that it does everything, which is why it's so important, because it measures everything that's moving, everything that's happening on price. So that's it. Any questions on any of that? Any other indicators you want to have a look at? Nobody sent me any because I said yesterday, if anybody's got any indicators they want to have a look at or clarify or whatever, let me know, but no one did. So I haven't got anything else. Time's up. Look at that, an hour. I'm getting good at this. So the questions bit obviously is where we overrun, isn't it? Morning, Harold, if I didn't say morning already. Noob on a grind. It's not always easy with mean reversion. No, this is the mean reversions. With mean reversion, it doesn't work in trends. It's trend. So yeah, but the condition at entry on this, for me, was there. It was a 4 hour. So the condition for me was there. So the condition for mean reversion was good. Yeah. Look, almost at the highs and then all the way down to those lows there. Within a week. Conditions correct. But this has nothing to do with making money. The signal has nothing to do with making money at all. Yeah, you make money by managing risk and reward. You make money by deciding what to do when you get in and analyzing what price does after your entry. The condition indicator could be a stochastic, an RSI, a CCI, a MACD, or a Bollinger Band. They will have all have told you to go long, all of them. Some of them would have told you to go long earlier. Some of them would have told you to go long later. If you'd have set the RSI instead of a 10 to a 14, you'd have got in a little bit later. If you set it to a 21, you probably would just about be getting in now. You're not even in. But if you set it to 21, you're never going to get in. It's just never going to get in. Yeah, you got one there. So it doesn't work, 21. That's why I don't use it. On the 4 hour, works on the 1 hour, but not on the 4 hour. And this is what I mean by fine tuning. So the RSI 14 would have got you in there. Exactly where I got in, yeah? So the RSI 10 and the RSI 14 condition indicator gave the same signal at the same time. Doesn't mean it's going to be right. It means the condition is met. The condition was met there. The condition was met there. The condition was met there. That was wrong 4 times for me, but the condition was met. The signal was bearish price action. A reversal alert. A whatever, it doesn't matter. The signal is irrelevant, isn't it? It's either going to do that or that. The signal and the condition lined up. That was why the trade was taken. The methodology applied to the price was position trading. If the methodology applied was a stop loss, I'd have lost money. And I would have entered again here and lost money. And I would have entered, that's it. So I would have just had 2 losing trades there if I'd have been a stop loss trader. As a position trader, I made a nice profit. But I didn't make a profit because of the condition or the signal. I made a profit because of the methodology applied, the risk reward structure applied to the price action that I saw on the chart. I'm in drawdown now because I've applied position trading to this condition and signal. If I had applied a stop loss to this condition and signal, I would have been entered long and stopped out, entered long and stopped out, entered long, still in it. So I'd be 2% down or 2 trades down in my third, needing a 3-to-1 risk reward ratio to break even and pay for those trades. So if I put a stop there with that entry, I'm going to need to get at least somewhere like there, 200 ADR from where we are, just to break even on that trade. If I use a stop loss. But that's the condition. Yeah, you know, this is what we're looking at. The condition indicator was market has moved. That told me market's moved. I can see market's moved. Yeah. You know, and again, the reason we have indicators and we use indicators as traders is because we're told to. If you put a bare naked chart of the euro US dollar up and remove all indicators from it, especially the brain trend to signal alerts, that is, yeah, and you scroll out, when you look at this drop here, let's say it's here, right? So you look at that drop. Where do you get in on that drop? Yeah, you can't, because you haven't got a condition. This is why you need indicators to trade. You could use a level. So you could use levels instead of a condition indicator, which is absolutely fine. That's price action at support resistance. Nothing wrong with that as a strategy at all. But you've got to have some kind of condition or indicator to tell you that the market has moved and set up because of something. Otherwise, you haven't got a way to get back out, a way to get into the market. So here you could say, I'm going to wait for price to stop moving down. It's probably stopped moving down. So that your condition could be that I'm going to wait for, I see price moving sideways. Still wrong. Sorry, bear with me one sec. Sorry, I heard a knocking. I was like, who's knocking on my office door? It's not. My wife's sweeping downstairs and she's knocking on the skirting board. It's really weird. So yeah, I mean this is the point of condition indicators is they are cut and dry. It's either they are or they're not. It takes all the discretion out of trading. The other way you trade is discretionary. So you would draw a box here from that low. So we got a nice low there, double bottom. We tapped it here. We saw the limit orders trigger. We came back down, limit orders triggered again. So I'd probably take these two levels and draw it out and go, right, that looks like a really good level. So my condition is, if price achieves this area again, the condition is met. That's my condition. My signal would be to wait for buyers to jump on board with me. So that failed. But has my signal been achieved in there? Again, signal is up to you. There's a 3-bar reversal there. Not a very convincing one, but there's a 3-bar reversal. My condition is met. My signal is there. There probably isn't a 5 or a 9 MA cross. Yeah, there was there. There was a 5 cross there. But price had already gone beyond my condition. So would I now have taken that? Discretion. Yeah. And this is the beauty of indicators. They've removed the discretion from trading. That is either a good thing or a bad thing. And that is dependent on how good of a discretionary trader you are. Also, for back testing, having a mechanical strategy which gives you a strike rate of condition and signal success gives you faith in a strategy. Without a condition and a signal, you can't build an automated strategy to see if something has potential of working in the future. It's never going to happen the same way as it's happened before, but it gives you that confidence that when RSI gets below, I always use the example of the 80-20 level. Yeah, when RSI on the 4 hour gets below the 80 and 20 level, it's taken a hell of a lot for price to do this. Yeah, a hell of a lot. Yeah, and the vast majority of the time, it's right, but it's not right sometimes. And the problem with trading like this discretionary is you could say, I'm going to use that as my upside resistance, or you could say, I'm going to use that as my upside resistance, or I'm going to use that as my upside resistance. This is the condition I'm looking for price to get to before I signal an entry. It's totally discretionary, and it's based on everybody's individual read of the chart. So the guy that took the short there was a lovely trade. The guy that took the short there didn't get to TP and got stopped out. The guy that took the trade here probably got stopped out immediately. He might not have even got in because he was watching that level and the condition wasn't right because it blew through his condition indicator. But all it is a condition in the market that has to be achieved, which has been seen to be repeated over and over again. And this is why oscillators for mean reversion specifically are incredibly useful. But for periods of accumulation as well, I mean, the 4 hour is, this is the wrong sort of one. You want to be using higher ones for accumulation, really. But, it just tells you without no uncertain terms, this is what's happening in the market. Just removes the discretion element. The POS-EA won't enter if it wicks off the MA. No, the signal in the position trader EA is open above and close below, or close open below and close above. Yeah. So, for example, here we opened below, wicked above, we closed below. Yeah. Here we opened below and closed above. That goes up. Same time. Same number calling me at the same time every day. Broker. Always a broker. Yeah. Remember price action. I don't know if you were in the price action session, but price action, wait for confirmation. Confirmation is close. Yeah. Until that candle closes, it's anything you like. Yeah. So this candle here is a good example. It opened here, right? At some point, that was a whacking great green candle with no wick. And everyone was looking at that. This is a 4 hour chart. So 2 hours into this movement, for example, we were looking at that going, that is a massive bullish 3-bar reversal. So I'm going long. Yeah. 1 hour later, you're sitting there going, holy crap, that is a massive shooting star candle. And then it pushed all the way down and you went, at the 4 hour close, I had indecision spinning top. Yeah. 3 different points in time during that candlestick. You had completely different readings on that candle, on that move. The price action intra candle is irrelevant because it's just price action. Where the candle closes over the last 4 hours, the bears were in control. Not just in control, properly in control, because they had to overcome all of that bull movement and then create their own bear movement and fight back the bulls. Big bear candle. However, it's still indecision. It's an outside bar, meaning that they didn't win and they didn't win. Because if they'd have won, it would have just gone down. But they didn't because it went up. But intra-candle, if you start taking signals intra-candle, look at a range, right? A candle can do that 7, 8, 9 times before it closes like that. Yeah. If you take every single one of those signals, you've lost 9% of your account before you got the signal, oh, actually, it's bearish. Yeah. Always wait for the candle to close. And don't forget, all a candle is a representation of price over time. So the view of the market that you have is different on every time frame. So when you look at a daily chart, you'd be saying today is bullish at the moment, isn't it? Look at an hourly chart. Actually, we're thinking about going bearish. You look at a 15-minute chart. Yeah, the bears are definitely in control of this market. You look at a 5-minute chart, you've probably had a reversal alert and you're already short. Which is the right thing to do today? Don't know. This is either going to go like that, and that bull candle is going to be like that on the daily, or it's going to go like that, and that is going to be a whacking great shooting star on the daily. But until this day is over, this is just banks and institutions executing price. Doesn't give us any information as to who won today. We'll tell you at 10 o'clock tonight who won. And right now, we're sitting at a weekly low. So either this is a very important day because either the bulls are going to win today or they're going to confirm a breakout. But right now, if this wicks down there and then closes up there, that's a failed breakout today. Again, it's just a representation of price over time. It means nothing at the moment. It will mean something when the candle closes. So you can't take signals while price is moving. If you're using a 5-moving average to go long, or a 9-moving average to go long, or a reversal alert to go long, and again, this is why this here, this is why this rectangle is here, and it's called the support rectangle, because it's supporting price. Yeah, price has hit this and bounced out of it. It's supporting price until a candle closes right underneath that last low that we've had. The bears are not in control. They can try as many times as you like, but it could fly off that way. Until they break that level, these guys are not in control of the market. It's price action, standard price action. Never trade intra-candle. You can if you want to, but you are literally flipping a coin. What you're doing, if you trade intra-candle, if you think about what you're doing, so let's say right now, this is a bad example. That's a good example, right? Right, so right now, let's say I hit the button now. I've got 42 minutes left on this candle. If I hit the button long now, because I'm seeing this wick and this wick, so it's at the moment it's wick rejection. Yeah, it's tweezer bottoms. Want to go long. Yeah, bullish price action. If I hit the button right now, what I'm actually doing is trading the price action on the time frames below me. Yeah, so I'm pressing the button now because on the 15-minute time frame, I have confirmation of a propulsion gap holding. Yeah, I've got higher highs going in. In fact, it's not very good price action on the lower time frame, but I am actually trading what's going on the lower time frame. I've had a reversal alert on the lower time frame and I'm retesting. On the higher time frame, at the moment, I'm seeing the same thing, but at the minute this isn't confirmed, this candle could end like that. In which case then, I'm not looking at bullish price action. I'm looking at bearish price action. In fact, I'm just looking at a 2 inside bar, aren't I? So you've got to wait for it to close, which is why you have to pick a time frame. If you keep, I see this, well, I don't see it anymore because I don't spend time with people in any groups anymore, but I used to see it so much. People would show charts and they would go, I'm going long here because on the hourly it looks like this, on the 15-minute it looks like this, on the 5-minute it looks like this, and we're down at a daily level. And I'm like, you've looked at 4 different representations of the market. Not one of those has got any closed price action to confirm what you're saying. What are you trading? Hourly, daily, weekly, 15-minute, 5-minute? What are you trading? What, it's no point in sharing multiple charts. Pick one and stick with it. You'll always see me in the live room here all the time. Yeah, there's similar time frames. There's only 4 candles in a 4-hourly candles in a 4-hour. They're very similar, but they're smoothed out. I enter down here when these guys are telling me to do something, but that today is bearish at the moment. Until we get above there, today's bear. 5-minute is a range. So if you're trading the 5-minute time frame right now, your condition indicator is telling you to get ready to go long or short. If you're trading the hourly time frame right now, price action is telling you that it looks like we're slightly bullish, but we haven't got confirmation of that yet. On the 4-hour time frame, we're waiting. Same instrument, totally different trading decisions, isn't it? I don't know why I'm talking about this. This is completely off tangent. But I was asking something about, the wicks, isn't it? This may be a basic question. How do you ensure that your position is always within ADR? You can't. You can't. That's your goal. You can't. Is the honest answer? Yeah, I would love every trade I get into to have price within ADR, because the whole purpose of trying to keep price, your average, as close to ADR as possible is that we know we hit ADR. Yeah, I come in to the live room every morning, and first thing we do is we look at the ADRs. In the New York session, we used to look at the ADRs. There was always a few ADRs. Price will always move beyond its average daily range on something, but usually not far beyond it. So if we can keep price within ADR to 150 ADR, you know that you only need one news event or one strong day to exit your position. If price is up at 225 ADR or 250 ADR, you're going to need multiple days. I wanted to confuse you. That's why. Yeah, I don't know. It's tangents, isn't it? I always go off on tangents, as you know. But yeah, ideally you want to keep it within ADR. And the way that you do that is by scaling into your positions within an ADR. So if you get in your first entry somewhere and price moves down half an ADR and you take a second entry with exactly the same lot size, your average moves into the middle. So if we've moved down half an ADR, you're dragging the average price down a quarter of an ADR. If it moves down another half an ADR and you enter another one, your price moves down to there. So we've moved down one ADR and now price is roughly 3/4 of an ADR away. When you get to 4 positions or more and your scaling in is somewhere around about, is there a calculation? Something like this. If you get into 4 positions and price is somewhere around about 1/2 to 3/4 of an ADR between positions, your average will usually be somewhere around about an ADR. When you go beyond 4 positions, you tend to then start to get further away from ADR. And there's nothing you can do about it. What you could do about it is increase the lot size exponentially. Yeah, so you can do this in the back tester. If you have ADR on your chart and you scale in with an equal lot size and price goes against you, you will find that it gets closer to ADR the more you scale in, and then it will eventually get beyond it. If you use the 1.5 lot multiplier, yeah, when you scaled in, this would be much closer and within ADR all the time. If you use martingale, it will never get beyond ADR, but your lot size will get ridiculous. Yeah, so there's no calculation that is best, because we don't get in using grid trading. If you were to do grid trading where every single trade is exactly the same distance apart, you could use lot multiplication or distancing to guarantee that you're always within an ADR. The problem is you would find that you would either take so many more trades or so much more lot size that when you get into a squeeze, you won't survive. The whole purpose of us getting in with the market reversal, let's say in the position trader EA, is that we get in on a signal of strength. We don't just get in. So if price moves down by 1/2 an ADR and there is no signal to go long, we don't get in. If it moves down 1.5 ADR and then we get a bull move, we get in there. So the distance between trades is 1.5 ADR apart. That is a variable, non-controllable, unless you just get in at 1/2 an ADR. But if you do that and price flies 3 ADR against you, you will be in 6 trades and price will not have had one bull candle in it. What's the point in taking 6 trades before you even get a signal that you've got any chance whatsoever of price going in your direction? That's grid trading. That's why that doesn't work. There is no calculation. What about for aggressive AS? Aggressive. Well, aggressive drawdown control brings price closer. Yeah. So if look at the US dollar CAD. So if I took an aggressive drawdown control position on this, 15 lots. So I would need to take an aggressive of somewhere in the region of 10 lots. If I take a 10 lot short now, I'm not going to, but if I did, my average would jump up to here. And this is what aggressive drawdown control is for. This is why we call it aggressive drawdown control. We are really wrong. The market has proved us wrong for a long period of time, and in this case, parabolically, and in drawdown. An aggressive drawdown control position is an exit. I need less than an ADR, and always, aggressive drawdown control will always, virtually always, unless you've got really bad spacing on your trades, will always give you an exit within an ADR. Which is why I say aggressive drawdown control you want to be doing at support resistance levels. Because when you get into an aggressive drawdown control position, you need previous proof that they are selling from that level. It's either a propulsion gap or it's a turning point in the market. When you get back to that turning point, yeah, I mean, there wasn't one there, but there was a propulsion gap there. But that would have been a beautiful aggressive drawdown control position. That's enough. That move there yesterday, or rather last week, from high to low was 90 pips. ADR is 60. You wouldn't have got that whole 90 pips. You would have got in where I got in because that was where the signal was. So you actually achieved 76 pips on that, 59 ADR. Yeah. So this is the point of aggressive drawdown control. This wasn't an aggressive drawdown control position. It was just a normal position. If it wasn't aggressive, it would have got me out. But I was only in 4. I don't get in, or 5 I was in. I don't get in aggressive necessarily at 5 positions, especially after going parabolic that long. But, this is the thing. And this is what I say about discretion. And, what I was trying to say to the guy in Andy in the chat yesterday, there is no mathematical equation that works, Harold. If you're saying, is there a mathematical equation to keep ADR within? If there was one, we'd do it. There isn't, because price is random. If price was uniform, we would know what to do. It's not. It's discretionary. So when you take an aggressive drawdown control is up to you. And that's based on your personal situation and what your thoughts are on what's going on in the market. Where we are now, this is my aggressive. If we were to get up to 150 ADR today, and you see it got aggressive short there. If we were to get up to the 150 ADR today, I'm getting in hard. Why am I getting in hard? Because that's where the market turns. Look. I'm short there, and I'm short big. But not because I want to make a load of money. And this is the other thing. Yeah, it's not about making a load of money. It's about getting out. You're wrong. What I want to do is minimize my losses on the incorrect trade, not milk this trade. And this, and this is again the discretionary part. The guy with the blue Porsche, Nick Shawn, right? He did a video on, he's basically copied all of my stuff. But anyway, he's changed his strategy because the one that he used before blew his accounts up. So he's had to he's scrapped everything he did before, and now he's moved over to what I do because that didn't work. So now he's doing this, but he's doing it in a very different way. What he's saying is, I want to get in, and I don't want to be right. I want to get in multiple times and be wrong. And I'm going to get in with so much lot size. When this comes down, I'm going to double my account. Bye-bye, Shawn. In 2 weeks' time or 2 months' time or 2 years' time, you'll be moving on to another strategy, mate, because that isn't how it works. But you can get in with an aggressive drawdown control position because you've got in with, in my case here, around about 10 lots. Let's say the Canadian news comes out massively bullish and this thing moves down 200 ADR. I'm not just out of my position and I haven't just got an exit. What I've got is about 15% profit on my account. But that is not what I'm looking to do because I'm really wrong. And yes, there's a high probability of that happening. But if it doesn't happen, I'm going to miss my exit. And it's about getting out without loss, not about getting out with huge gains. Occasionally, I have had aggressive drawdown control positions on which have gone into accumulation for a day or so. Haven't stopped me out. I've gone out. I've done something else. I wasn't at the charts and a news event has driven this down. And I come back to my chart and I'm like, holy crap, 8%? Close all. Yeah. This happened because I wasn't here. If I was here, that would have closed out at 2% or 1% or break even. But because I was making a cup of tea, I got 8% out of it. Random discretion. None of this can be planned to any detail that is going to give you a guaranteed income of either loss or of profit. Because this thing, for example, could have a massive drop today for some reason. Trump could get assassinated today. Yeah, or something like that. And this thing suddenly at 200 ADR. I'm out walking the dog. I come back in. The reason I have made a huge profit is nothing to do with my strategy, my condition indicator, my distance between trades, the fact that I've got an aggressive drawdown control on or not. It's because Trump got assassinated, or a nuclear explosion happened in Iran because they hit something, or whatever. Yeah, random. So your job is not to, your job has got to be decide on spacing, because you've got to have a minimum distance between your entries. The further they are, the worse, the harder it will be to get to ADR. The closer they are, the more drawdown you're going to take. There's always a payoff. And this is what backtesting is about. Backtest the position trader EA. Run the same strategy with spacing of 0.25 ADR to 1.25 ADR. And run a system parameter permutation test of 0.25 between them. Yeah, so you'll get 1, 2, 3, 4, 5 tests. Look at the drawdown difference. This one will have the biggest drawdown. This one will have the lowest drawdown. This one will have the fastest exit time. This one will have the slowest exit time. They will all become profitable. But the effect is what's happened in the past. What's going to happen from the next button press is random. And you don't know which of these is the best to use because you don't know what's going to happen in the future. But as long as you understand the impact of having wide spacing and close spacing is more loss or more drawdown or less drawdown, you can make your own decision up about the calculation that you use. And it's totally down to you. There isn't a right or a wrong, because price will come back down again. But the amount of drawdown that you are in here and I am in here will be dependent on whether you did that or whether you didn't do that, or whether you closed 50% of it or 100% of it, or whether you spaced out so that your entries are there, there, and there, instead of my entries, which are there, 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 and there. Yeah, we're in the same trade for the same reason. The condition was met, the signal was triggered. But what we're in and how we get out and the amount of money we make is completely individual. If we're using the same set file exactly, we will get the same result. But what's the right one to use? Don't know. If you use my one, like somebody said, like Andy said in the group, I'm in loads of drawdown on US dollar CAD. I'm uncomfortable. I'm not. He is. Right, we'll use bigger spacing. Yeah, but you don't use that. No, because I'm a different person. I have a different risk tolerance. I can take a 3.5% on my loss, a loss on my account by pressing a button. Can you? I don't know. Oh, if you don't know the answer to that, how can you pick a set file? You can't. Just use something. Get in, experience the market, and decide what you need to do. That's all you can do. Calculations will give you, and backtesting will give you examples of what is likely to happen. It will never tell you what is the best thing to do, unfortunately. And that's what everybody spends their life doing, trying to find the best, find the holy grail, find the thing. There isn't a thing, because this thing is random. So it's all about finding what was best for you. What risk parameters fit you best? Position trading, stop loss trading, hedging. Yeah, some people do this and they go, you're a lunatic. You're never going to survive doing that. I beg to differ. There's 5 years of YouTube video proof that I have survived doing this. But you won't watch it all, and I can't be bothered to talk to you about it. If you don't like it, don't do it. It's not for you. Off you go. If you want to use stop losses and come back to me and say, I've been I've lost 10 trades in a row, or come back and say I've had 10 winners in a row. Brilliant. Come back in 2 years' time and tell me that you've done that. If you have, we'll talk. Because if you found a stop loss strategy that survived for 2 years, especially if it's below a daily time frame, I'll have it. Yeah, but it's, you know, it's random. This thing's random. The decisions you make are random. Who's Nick Sean? He's just another guru. Don't. If you go and look at him up, you'll go and buy his course, and I don't want to give him any money because it's all a load of bollocks. So yeah, his latest thing, he changes strategy constantly. When it's working, he gets a load of members. When it doesn't work, his members disappear, and he replaces them with people for a new strategy. He's just changed his strategy to something else. Funnily enough, he's changed it to exactly what I do, position trading. He's probably been in here doing my course in the live rooms, and now he's gone, yeah, that's good, I'll now peddle that. Yeah. But he won't, he's doing it, I mean, I can tell he's doing it wrong. For a start, he's standing on screen with an AK-47 or some kind of submachine gun. Yeah. First of all, he needs banning from YouTube. If YouTube are allowing people to stand in front of other people with machine guns and pistols when they're trying to sell trading courses, they need to be fucking banned and locked up. Sorry for the language, but that's my opinion. The guy's a complete idiot. Anyway, that's Nick Shaw. If you want to go and look him up, and the reason I call him the Blue Porsche guy is because everybody's paid him tens of thousands of pounds and he's bought himself a Porsche and told you he bought it, he got it through trading profits. He didn't. Lies. Prove me wrong. It's probably in it now. Anyway, okay, we'll move on from that one. Most people look for a set and forget EA. Yeah, there's very few that work. There isn't any that work. The ones that work, there's a few on the marketplace that work, and they are, where are my experts? The ones with the signals. So, for example, here, the best way to do it actually is to look at signals. Yeah, go to signals and find the ones that are old. 2022, 99.99% algo trading, 468% return. Yeah. Guess what this is doing? Position trading. Look at the drawdown. Yeah. Tiny drawdown, but it's tiny risk. Look at the percentage returns. Yeah. Right. This is how they get you. Right. This is making 3, 8, 1, 4, 5, 4. I can produce this with the position trader EA. No problem. Yeah. Are you happy with that as a return each month? Yes. Brilliant. You must have 100 grand account. No, because you've got a 2 grand account and making $24 a month ain't going to cut it. What's the point? Yeah. Or whatever it is. But look at this. In December, it made 50% return, 121% in its first year. Second year, 72%. Third year, 48%. Why is it decreasing in profitability? Because it's using fixed lot, increase in size, which means the return is reducing. If he had used a incremental lot, which you would do as a trader, that 7% would be more likely 30 to 40% because it's position trading and holding on to trades forever. And I can do that. If I had a 100K account and I used a 0.03 lot size on it, I would never lose. But I also wouldn't return enough money to make money. I wouldn't return enough. Yeah, so you've got to be very careful with these things. But these are the ones that work. And they work because they're not using a stop loss, which allows the market to move. Yeah. He's using Robo Markets, look. .3% drawdown. But, you know, this is the same, you know, it's the same thing as I do. This is it. That's how it works. That's how trading works. Yeah, this is what the banks and institutions do. They DCA. You'll hear them on Bloomberg all the time. I've said it before. You'll hear them all on Bloomberg talking about dollar cost averaging. They all do it. Why do they do it? Because it's random. You can't predict when things are going to turn. You know that things will turn because things can't go up indefinitely. There's a rule that banks and institutions cannot spend every penny they have doing one thing because you can't make money. If you just buy forever, you will never profit. There has to be a pullback. There has to be a profit take. They know that. Yeah. You can't time it, so you have to apply risk to the move. That's what we do. The more risk you apply, the more drawdown you will take, the more danger you will have. But everyone can produce, like Harold, your account, yeah? You're using tiny lot sizes constantly, yeah? I'm not. I'm in 15 lots short on this because I've got a much bigger account. If I was 5 lots short on this, I wouldn't even be talking about drawdown. Now I'd just be sitting there waiting for the US dollar to come down. It's really annoying, isn't it? I can take another 5, 10 ADR up, but it's just annoying it's not coming down. But when it comes down, I'm going to make 0.05% on my account. What's the point? Yeah, these types of EAs are doing just that. You're not going to make any money. Over 3 years, you have made money, you've made equity, but the risk is just not applied correctly to the account size. My account size is whatever it is. I have around about 100k, but it varies. I have more than that because I trade more than one strategy. But your risk is allocated to your account size, which is why I say you risk a percentage of your account. I have one running for 1 year plus that works good. Yeah. Boring pips EA. Yeah, there's loads of EAs that do it on full auto, but they will be using tiny risk. This is the thing. It's all about using risk. If you use small risk, you will make money. You know, this is the thing with the coin flip thing. If you don't use a stop loss and use a coin flip, you'll make money because the market will either do that or it will do that at some point. Yeah, there is no chart you can show me that has gone up forever. There isn't one. Yeah. There's COVID. No, yeah, that's COVID, right? So it went down and it went back up again. I'm out. All the way in here, it went up, it went down, it went up, down, up, down. All it does is go up and down. If it goes up a long way, it comes down a long way. If it goes up and down, it goes up and down, it goes up and it goes down a long way, and it comes up a long way. 99% of the time, it does an A-shaped recovery or a V-shaped recovery over X. This is the variable, time. You cannot control time. This happens 100% of the time. All you do is you apply risk to that. That's how money is made in trading. It's as simple as that. There is no chart you can show me that has not done that. If you use a 0.01 there, you will be out there. You would have been out there or there or there. Somewhere around here you'd have been out, but it doesn't matter. There is no chart on the planet anyone can show me that goes like this. And unless there is one that goes like that, this strategy works. And it has worked for me for 5 years. But no one believes it. But you show them charts like this and you go, yeah, but I wouldn't have held it that long. You would have if you had 0.01 account running on a full auto with an EA that was told to do that. Try it. Put a 100 grand account and start with a 0.02 lot size so that it can do incremental trading. Yeah. Yes, it's going to take some drawdown. It's going to hurt, but it won't go pop. Because it can't. It can't go pop because it's never going to go up. Look at the US dollar yen. Fibonacci, we're covering this tomorrow. There isn't a chart on the planet that does not conform to Fibonacci ratios. There is not a chart on the planet that has gone parabolic forever without retracing a minimum of 50%. Worst case scenario, 38. We're only looking for an ADR. Yeah. You just got to hold. And this is where people go wrong. They get in too big and they go pop and they go, well, it doesn't work. No, it does. You just got in way too big, which means you have to take losses. I have taken a loss of 3.5% yesterday. Why? Because I'm a bit too big on it. It's my fault. But it will come down. Yeah. This thing is coming down. Look at the size of that move. 38 retracement. 71.9 retracement. It's coming down. It might go 100% retracement before it comes down. I don't know, but it will. Because it does. Always. Everybody that was long on this was crapping themselves until they stopped crapping themselves. But they did stop crapping themselves because it did that. And the only reason it did that was because the banks and institutions did that. And if the banks want to make money, they have to get out of the move. You cannot make money with, like, if you're long short on this now, let's say you were long on this now, right? Your P&L is sitting in 20k. I don't know, whatever your profit is sitting in, yeah? How do you realize that 20k? Turn that open P&L into closed P&L. You shut it. When you shut it, you press the sell button. When you press that button on a long trade, that button is executed. When you press that button on a short trade, that button is executed. You do the opposite. If you've bought something, you need to sell it to exit. If you sold something, you need to buy it to exit. That's all the banks and institutions are doing. There's just a hell of a lot of them doing it at the moment, which means a hell of a lot of them are going to do that, which means that that happens quickly. That happens quickly. That happens quickly. That happens quickly. That and that and that. That's all it does. It's all it does. Your job is to scale into this and wait for the exit, which is at some point in the future at an undetermined point and price that we don't know about yet. That's trading. A condition needs to be achieved to get you into that with a signal, which is what we've discussed today. An exit has to be taken. The exit can either be profitable or a loss. You choose. There's a line on the chart. If you close it now, it's a loss. If you close it when it's below the line, it's a profit. Discretion. There is no system that is not discretionary unless you are using a risk which can sustain anything, which you can. You just won't make much money. That's what the pension funds are doing. Yeah, the pension funds will take up to 40% drawdown on their accounts. Believe it or not. Yeah, they take massive drawdown, but they take drawdown because they have a formula that has never gone wrong. Yeah. There are points in time, like COVID, where it could go wrong, but it didn't, did it? Look at the pound US dollar in COVID. Quite a way back now, isn't it? Long time ago, COVID. Got to go a long way back. 61.8 stroke 70.19 retracement. Yeah. But if you were long here and you had an executed plan, you had no problem. But if you got long here with 1% risk, you were dead by here. If you got long here with 0.01% risk, you're in 40% of drawdown before you came back and made a huge profit, or you got out at break even, or whatever happened. Whatever happened was discretionary. But what was survivable was that due to the risk size. Yeah. Same as when Liz Truss crashed the economy. Bailey bailed us out because the banks were in massive profit on the short selling that they were doing because the risk profile changed. To make money on the move, they had to get out of it. Yeah. If you scale in 100% of the move and only scale out with 71.8% of it, it means you are still short 30 something percent, 28 point something percent, aren't you? Yeah. It's all to do with percentages, isn't it? If you get a V-shaped recovery on a chart, it means that 100% of the shorts have exited because there is no way to achieve it. Every single buyer has to have a seller. It's an equal exchange. There is no way you can not have a V-shaped recovery at some point in the market without somebody being long or short bias. Yeah. If it only gets to here before it goes down, it means that there is still people from here that are short. Otherwise, they would be out because it's one in, one out, one in, one out. That's how it works. They're contracts. You're trading CFDs, contracts for difference. Every move is tick is a contract, isn't it? In effect. My account's on 73 on initial 0.1 lot size. Yeah. But the way that you're trading, Harold, is not actually correct because your risk is all over the place. Yeah. A 0.01 long on pound US dollar and a 0.01 long on US dollar yen have got a completely different monetary amount attached to them. So you will find you will be much bigger in drawdown on things that go into squeezes against you on your base currency than you will on a cross currency. Yeah, which is why the EA uses percentage risk, because a percentage risk is a percentage risk on every instrument. A 0.01 lot size has got a completely different monetary value on every instrument. Not the best way to do it. So you've either been lucky or unlucky. Doesn't matter which, but it's different. Yeah. You can do it in very easily. Look, if I go, and again, look, if I go 0.25 risk, I don't think I'm going to be able to do it with this, to be honest, because, oh, bloody hell, that's loud. You can't target properly, but so that's using 0.25 risk. It made 1,838. If I use a 0.1 lot size, I'll get a totally different result. Made a $3,000 loss. But the reason it made a loss is because the risk was different. Yeah, 0.01. The best way to do this, if you go, okay, look, I'm going to put a 0.01 lot pending order. On pound US dollar long. Whoops, go on depth of market. Buy stop. Right, and I'm going to put a stop loss on it at 100 pips. So that's worth $9.90. Same trade here. $100 pips. Well, that's way too big. $6.89. Yeah. So the same lot size here is worth 2/3 of the amount of money. So if all of my trades that made a profit were on the US dollar yen, I'd make 2/3 of the amount if I'd have traded the pound US dollar. However, if I'd have traded all of mine on the pound US dollar and the pound US dollar was the one that went into drawdown and squeezed for 6 months, my overall drawdown on my account would be way bigger on the pound US dollar than it would on the US dollar yen. If I risk $100 worth or 1/4% or whatever over that distance, it's 1/4%. The monetary value doesn't change. It's $100 risk. That's $100 risk, and it's $100 risk on the pound US dollar. Yeah, which is why the EA uses percentage risk, because it's a completely different amount of money on every instrument. If you go with the same lot size long on the New Zealand, on the NASDAQ, and the same lot size long on the S&P 500, 1 hour later, you will be in completely different monetary profit or loss, even if it's moving exactly the same distance, because the monetary size there for 0.1 is totally different. And you must understand that because it's very important. Yeah. If you get, if something goes into drawdown on your account that costs $10 a pip, and something goes into your drawdown on your account that costs $50 a pip, yeah, the drawdown's different. Yeah. By entering a 0.01 on both of those, that is the scenario you're getting yourself into. Which is why everything on here works either on monetary amount or percentage. Monetary amount or percentage. Yeah. I have a fixed lot there, but you'll see that there's no way to exit on a fixed lot size because you can't. You've got to risk amounts of money and percentages of your account. Pound US dollars on the move. I'm waffling. It's nearly 2 hours in already again. US dollars moving a little bit. Can we automate some fib strats? Yes, we could do. Very hard to do because fibs are discretionary. So I do money risk, yeah. Yeah, so it doesn't matter. I'm risking 700 over one ADR of movement. ADR of movement is dynamic and individual in each instrument. Therefore, I'm risking 700. If it moves a day, I'm risking 700. If I had a fixed lot size and it moves a day on the pound, US dollar, and it moves a day on the US dollar yen, that's a totally different amount of money. Yeah, fib strats are very difficult to automate because they're discretionary. Yeah. Where'd you measure that move? From there or from there? Whoops. Or from there? Where's the origin of this move? Discretion. I've automated fib strategies before. The only way you can automate them is on daily movement or weekly movement, which somebody's got a strategy. Peter? No, hang on. What's his name? Philip. They sent me a strategy based on fibs, but I can't quite understand it. So I've asked him for clarification on it. But it's discretionary unless you are using daily movement or weekly movement, because other than that, you pick where you put your fib. You know, you could put the fib here. Oh. My TP now. Yeah, you could put the fib there. You could, I mean, this one's pretty straightforward, but it depends on your view of the chart, doesn't it? And again, if somebody's using that time frame, they're going to draw a different fib to someone that's using that time frame, to someone that's using that time frame. You can use swing points using zigzag, and fib working on zigzag is doable. The trouble is zigzag's dynamic and repaints. So when you take a trade, all of a sudden it looks like you shouldn't have taken a trade because it's a repainting indicator. Very, 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 very hard to automate. But we could set up rules for it, I guess. I have tried in the past, though. Very hard. I still feel the offshore accounts. Fear the offshore accounts. Spending 50k or more in Belize. Yeah, don't go to Belize then. It's no other way to trade. I've been doing this for 17 years. And I've used UK brokers up until a decade ago. I haven't used a UK broker for a decade, apart from DarwinX, but that's a small amount of money lodged in there, and it's all covered. So yeah, you don't have a choice on that, unfortunately. Or you do have the choice and you set up loads and loads and loads of different brokerage accounts and you just trade one currency in each. That's the other option, which is doable, but incredibly hard to manage and an absolute pain in the arse. So not really what I would want to do, but anyway. So I'll leave it there today. That's covered everything I think I want to cover today. Tomorrow we are going to look at levels, target and level indicators. which is basically fibs, propulsion gaps, bank levels, and ADR. Excuse me, and how to employ those properly, really. And again, they're all discretionary to a certain extent, apart from ADR. ADR is a calculation, but the rest are all kind of discretionary-ish. So it's looking at using those as condition indicators as well, like we did a little bit of today, but more for target. So level indicators are very, very good for target indicators. Yeah. So we've got condition indicators, signal indicators, and target stroke level indicators, but the level ones are kind of a bit of a hybrid. So right, that's it. That's all I've got for you today. Anything else you need, let me know. I'll be in Discord. If you've got any other questions, you're watching on replay, down the bottom. If you're still here watching on replay, well done, 2 hours. So everyone now can go off and watch Nick Sean's video. In fact, I'll show you his latest video. And this is why I'm not getting irate about him, but why, you know, when we talk about professional traders, yeah. Sorry. No. He uses a handgun and a, I don't know what that is, an AR-15 or something, assault rifle, MP5. Don't know what that is. I know far too much about guns, playing far too much Call of Duty. But start adding to losing trades, right? Go down. Hedging, forex hedging. Why it's better than anything else. You go down, and all you find is he is system hopping. He said he's documenting his system hopping and sending you a course on everything he system hops to. Yeah. There's 1,000 of these guys out there. They're not going to help you. Well, they will help you for a short period of time, but not for long. I'll leave it there. Great content. Good. If you need anything, let me know. I'll be back tomorrow at the same time, and we'll obviously do the 8 o'clock session and then the 9 o'clock. And then on Thursday, Friday, we're hoping to do daily strategies. Although I've just realized I've broken my EA that trades the strategies and lost one of them. So I'm going to be working to try and replicate those. So we might change Thursday and Friday. If Philip gets back to me, I don't know if you're in here, Philip, obviously not. But if he gets back to me, we might try and do his strategy. But I'll see. I'm hoping to get them back, but I've realised I've broken one of them. So yeah, my fault. All right, have a good day. Anything you need, let me know. Other than that, I will see you next time. Have a good one.